All right, let's dive in. Today, we're cracking open one of the most powerful and, let's be honest, most confusing forces in the global economy, investment banking. It's this whole world that seems to run on secret handshakes and billion-dollar jargon. But trust me, by the end of this, you're going to understand the engine that makes it all go.
So just think about it for a second. How does a tiny startup, maybe just a spark of an idea in someone's garage, turn into a massive public company? You know, the kind whose stock you can buy and sell every day. It's a huge journey, right? And the answer, pretty much every single time, points back to one place: an investment bank.
So to really get that journey, we've got to start with the basics. We have to understand the vehicle that powers the whole trip. So what exactly is an investment bank? What do these places actually do?
At its absolute core, an investment bank is basically a financial matchmaker. It's their job to connect people who need huge amounts of money, like a company that wants to build a giant new factory, with the people who have that money to invest. They are literally the bridge between big ideas and big capital.
Okay, and this is a really important point you need to get straight. This is not your local bank where you go to open a checking account. Not at all. Investment banks aren't in the business of holding your savings. Their entire world, their whole reason for being, revolves around one thing: making big, complex deals happen. So what do these deals actually look like? Well, they mostly fall into four big buckets. First, they help companies raise capital, which just means getting money by selling stocks or bonds. Then they act as the main advisors when one company wants to buy another. That's called M&A. They also have huge teams that are constantly buying and selling stocks and bonds, which is sales and trading. And doing all the homework behind the scenes is research, the analysts trying to figure out what everything is actually worth.
You can't just think of an investment bank as one big building either. It's this incredibly complex machine with a lot of different moving parts. And it's not just about the bank itself. There's a whole ecosystem of other major players out there. So let's meet the cast of characters.
Inside the bank, you can basically break it down into three parts. You've got the front office. These are the stars of the show, the bankers and traders who bring in the money. Then you have the middle office. Think of them as the referees or the risk police. They make sure the front office isn't taking insane risks and is following all the rules. And finally, you've got the back office. They're the crucial support system, handling all the tech, the paperwork, the logistics, basically making sure the lights stay on and everything actually works.
Okay, so we know who's inside the bank, but who are they actually talking to? I mean, all these big deals need someone on the other side of the table with really, really deep pockets. Let's take a look at the big investors they're working with.
First up, you've got venture capital, or VCs. You've probably heard of these guys. They're the ones who bet on the future. They hunt for those tiny, promising startups that have a brilliant idea but almost no money, and they give them the cash to grow. They're helping one of those bets becomes the next huge tech giant. They're investing in the dream, the potential.
Then you have private equity, or PE, and they're playing a totally different game. Instead of funding new ideas, PE firms usually buy companies that are already established and mature. They take full control, try to make the business more efficient and profitable, and then, a few years down the line, they sell it for a big profit. They're all about optimizing the business.
And rounding out our big three, we have hedge funds. Now, these guys are different again. Unlike VCs or PE firms that get really involved with the companies themselves, hedge funds are all about playing the financial markets. They use all sorts of complicated, aggressive strategies to try and make money for their investors, whether the market is going up or down.
Okay, so we've got our players, the banks, the VCs, the PE firms. Now for the main event. This is the moment where they all come together for one of the most famous processes in all of finance, the initial public offering, or IPO. This is how a private company finally sells its shares to the public for the very first time.
The road to an IPO is a marathon, not a sprint, and the investment bank is like the Sherpa guiding the company every step of the way. It kicks off with underwriting, where the bank basically promises it can raise the money. Then comes the really heavy lifting, due diligence, where they investigate every little detail about the company. All that info gets packed into a giant legal document called a prospectus. After that, it's all marketing. They go on a roadshow to pitch to huge investors, building a book of orders to figure out the perfect price. And it all leads up to the big day, listing day, when the stock finally hits the market.
And let's just pause on due diligence for a second, because this is so important. This is where the bankers and lawyers literally comb through every single contract, every financial statement. They have to make sure every claim the company makes is true. It's all about protecting the investors and, just as important, the bank's own reputation.
And that roadshow we mentioned? You can think of it like the world's most exclusive and high-stakes concert tour. The CEO and CFO of the company, coached by their bankers, fly all over the world. They meet with these giant investment funds, trying to build excitement and get them to commit to buying millions of dollars in stock before it even goes live.
This whole crazy process, it all boils down to one single massive question. A company that has never been publicly traded before, well, how much is it actually worth? What should that starting stock price be?
I mean, really think about that. For a young, fast-growing company, this is so tough. You're not just putting a price on what it's making today, you're trying to value its potential, its brand, its technology. You are literally trying to put a precise dollar amount on a vision for the future. So how on earth do they do it?
Well, bankers don't just pull a number out of a hat. They have this whole toolkit of financial models they use. They'll try to predict every dollar the company is going to make in the future. They'll compare it to similar companies that are already out there on the stock market. But maybe most importantly, they listen. A huge part of that roadshow is just to see what the big investors are actually willing to pay.
So, at the end of the day, you have to remember this. Valuation isn't just a math problem. It's part hard science, complex spreadsheets and financial models. But it's also part art. It's about understanding what people are excited about. It's about telling a good story. It's about psychology. The final price is where the cold hard numbers meet the human narrative.
And just to give you a sense of the scale we're talking about here, check out this number. That's how much money has been raised for companies through IPOs around the world in just the last few years. That's not just a number on a screen. That is the fuel for incredible innovation, for global expansion, and for millions of jobs, all made possible by this exact process.
Which brings us back to the big picture. There's just no denying that investment banks are at the very heart of modern capitalism. They channel the money that builds corporate empires. But it leaves us with a really big question to think about. Are they an essential engine for the economy, or are they the architects of an unbelievably complex, high-stakes game? The answer? Well, like valuation itself, it's probably somewhere in the middle.